SolarEdge Technologies, an Israeli company that once dominated the residential solar inverter market and rode a clean energy supercycle to record revenues, then watched demand collapse with breathtaking speed.
SEDG is a turnaround story in progress. Heavy losses, high short interest, and a management team trying to rebuild margins in a market that punished the entire solar supply chain.
The story begins in 2006 in Herzliya, Israel, engineers who invented the DC power optimizer. Each solar panel optimizes independently, solving one of residential solar's core efficiency problems.
The company went public in 2015 and became the go-to supplier for U.S. residential solar installers. By 2022, it was generating over $3 billion in revenue as solar installations boomed.
Then came the reversal. California utility rate changes decimated rooftop solar economics in the largest U.S. market. Rising interest rates made solar financing harder. Installers stopped buying as inventory piled up across the channel.
Revenue cratered from $3.1 billion at the peak to roughly $1.2 billion, a decline exceeding 60% in less than 3 years.
Energy storage, batteries for residential and commercial systems, adds another 15% of revenue. EV charging and industrial power round out the product breadth.
The unit economics are under severe stress. Gross margins that once topped 30% have been squeezed toward mid-teens as SolarEdge absorbed high-cost inventory, reduced volumes, and faced pricing pressure from Chinese competitors.
Operating losses are significant. R&D spending remains near 20% of revenue. SolarEdge is still investing in next-generation products, even while cutting headcount and restructuring its cost base.
Enphase Energy is the closest rival. Higher margins, stronger balance sheet, and a microinverter architecture that competes directly with SolarEdge's optimizer approach. Enphase has outperformed SEDG significantly through the downturn.
Tesla Energy brings Powerwall storage into the residential solar equation, competing where SolarEdge wants to grow. SolarEdge counters with installer relationships built over 15 years, a genuinely sticky distribution advantage.
SolarEdge scores well on technology IP and installer network. Its cloud-based monitoring platform and optimizer compatibility give installers a sticky ecosystem. But balance sheet and margin scores reflect the current distress.
Millions of residential and commercial solar systems globally already use SolarEdge optimizers, each running on its cloud monitoring platform, generating data and creating recurring service relationships.
The installer channel is the critical distribution layer. Solar installation companies specify the inverter brand on every job. SolarEdge's installer loyalty, built over years, is the moat it is trying to preserve.
Zvi Lando has led SolarEdge since 2020, a veteran of the company's R&D and product organization who stepped into the top role just as the macro environment began turning against the solar industry.
Lando's tenure has been defined by crisis management, workforce reductions, product rationalization, and rebuilding the cost structure. He has been clear that recovery requires market normalization, not just internal efficiency.
SolarEdge Technologies, a once dominant solar inverter company navigating one of the sharpest revenue contractions in clean energy history. The technology is proven. The market headwinds are real. The recovery timeline is uncertain.
The next earnings release will be a key signal. Any improvement in order flow, inventory normalization, or gross margin stabilization could shift sentiment sharply in a high short interest stock.
SolarEdge Technologies reported Q1 2026 revenue of $310 million, up 46% year over year, and beating the $307 million estimate. Adjusted EPS of negative 43 cents missed the negative 28 cent estimate, signaling wider than expected losses. The stock fell 7.5%. SolarEdge continues recovering from the 2024 inventory crisis. This is Charged Alpha. I'm Hudson.
And I'm Lana. SolarEdge Technologies designs and sells power electronics for solar energy systems, primarily inverters and DC power optimizers that maximize solar panel output. Revenue comes from hardware sales to solar installers in residential and commercial markets globally. The company is also expanding into battery storage, EV charging infrastructure, and grid services. Market cap is approximately $1.75 billion.
SolarEdge built its position as the leading alternative to Enphase in the DC-optimized inverter market. After explosive growth from 2020 to 2023, SolarEdge faced a severe revenue decline in 2024 when European residential solar installer inventory surged and demand collapsed. Recovery efforts have included restructuring, product rationalization, and renewed focus on commercial and industrial markets, where demand has been more resilient.
SolarEdge reported Q1 2026 revenue of $310 million, up 46% year-over-year, beating the $307.3 million estimate. The year-over-year comparison is favorable because Q1 2025 was still in the trough of the inventory correction. Revenue came in above estimate across residential and commercial segments, with commercial showing stronger recovery momentum.
Non-GAAP EPS of negative 43 cents missed the negative 28-cent estimate. Losses per share are wider than investors expected despite revenue recovery. The EPS miss reflects elevated operating costs from restructuring charges, product development investments, and manufacturing overhead that has not yet scaled with recovering volumes. Gross margin improved year-over-year, but remains below the 20+% level SolarEdge needs for sustained profitability.
The gross margin story is central. SolarEdge's gross margin in Q1 was approximately 16%, recovering from near-zero margins at the trough, but significantly below the mid to high 20% range the company generated at peak revenue. Management cited input cost normalization and production volume recovery as margin improvement drivers. Full profitability requires gross margin consistently above 20% at higher revenue scale.
Geographic recovery is uneven. European residential solar, the epicenter of the 2024 collapse, is showing early signs of restabilization as installer inventory has largely cleared. U.S. solar demand has been more resilient, supported by Inflation Reduction Act incentives. Asia-Pacific is the early growth region, with commercial installations driving volume recovery, independent of the European residential cycle.
Battery storage and grid services represent a growing second revenue stream. SolarEdge has built a commercial energy storage business that is scaling alongside the core inverter segment. Storage revenue grows at a higher rate than inverter sales as commercial customers pair storage with solar installations. Management views storage as a multi-year margin expansion driver once manufacturing scale improves unit economics.
SolarEdge guided Q2 2026 revenue in the range of $325 to $355 million, implying continued recovery. The guidance range confirms revenue trajectory is positive, but the wide band reflects lingering uncertainty about European residential demand and potential policy changes to Inflation Reduction Act solar incentives in the United States.
Analyst reaction to Q1 was mixed. The revenue beat was viewed positively, evidence that SolarEdge's trough is behind it. The EPS miss was the concern. Analysts had modeled a more rapid margin recovery that has not materialized. Most analysts maintain hold or market perform ratings, waiting for gross margin to sustainably exceed 20% before upgrading. Bear case targets cluster below $25.
The margin recovery timeline is the central debate. At 16% gross margin, SolarEdge is not generating enough gross profit to cover operating expenses at current revenue levels. Bulls argue that each 10% increase in revenue volumes, from $310 million toward $500 million, will lift gross margin by 3 to 5 percentage points through fixed cost absorption. Bears note this math requires revenue to grow 60% from current levels.
The IRA policy risk is unique to SolarEdge's U.S. recovery thesis. The Inflation Reduction Act provides solar investment tax credits that have supported domestic demand. Any legislative modification to IRA incentives would reduce near-term U.S. solar installation activity and slow SolarEdge's recovery. This political risk is real. Bipartisan support for IRA solar provisions has shown stress in recent congressional debates.
The competitive pressure from Enphase is intensifying. Enphase, the microinverter leader, has been taking share in the residential market where SolarEdge's DC optimizer architecture competes most directly. Enphase's system-level approach, combining microinverters with battery storage, offers installers a simpler product stack. SolarEdge must differentiate on price, performance, or battery integration to prevent further residential share loss.
Valuation reflects deep uncertainty. SolarEdge trades at approximately 1x revenue, a multiple consistent with a company in turnaround with uncertain profitability timelines. If revenue reaches $700 million annually and gross margin exceeds 20%, the stock could re-rate significantly from current levels. The current price embeds a scenario where recovery proceeds, but full profitability is years away.
The bull case is gross margin recovery to 20+%. SolarEdge generated margins above 25% in 2022 and 2023. As revenue scales from $300 to $500 million quarterly, fixed manufacturing costs become diluted and margins recover. Bulls model this recovery, driving the company to sustain profitability by late 2026 or early 2027.
The inventory clearing in European residential solar is the key near-term catalyst. Channel checks suggest European installers have mostly worked through excess inventory, positioning for a potential restock cycle in the second half of 2026. European residential solar typically peaks in the summer installation season. If distributors restock at a meaningfully higher rate than 2025, the revenue recovery could surprise to the upside.
Battery storage and commercial solar provide a floor on recovery. SolarEdge's diversification beyond residential solar, commercial and industrial installations, grid-scale battery projects, provides revenue less exposed to the residential inventory cycle. These segments are growing and were less affected by the 2024 correction, giving the company a second recovery track independent of residential demand.
The bear case is EPS misses continuing. SolarEdge has missed EPS estimates in multiple consecutive quarters as costs have outpaced revenue recovery. Each miss reduces analyst confidence in the margin recovery timeline and pressures the stock multiple. If Q2 2026 gross margin does not show meaningful improvement from Q1 levels, bears see limited near-term catalyst for stock re-rating.
Enphase competition is intensifying in residential. Enphase's simpler microinverter system has been gaining US and European market share. SolarEdge has responded with system-level products, but has lost residential brand positioning. If the residential recovery is smaller than expected because Enphase captures incremental share, SolarEdge must rebuild on commercial and storage alone, a slower path to profitability.
China competition creates price pressure. Chinese inverter manufacturers, Huawei, Sungrow, and others, are aggressively entering European markets at prices that undercut Western manufacturers. SolarEdge and Enphase are pressing for trade protection, but Chinese inverter pricing creates a ceiling on SolarEdge's pricing recovery even as volumes improve. Gross margin recovery may be limited by competitive price dynamics.
The balance sheet adds risk. SolarEdge has been burning cash during the inventory correction period. If revenue recovery is slower than guided, the company may need to raise capital through equity or debt, diluting existing shareholders. Cash runway remains adequate for near-term operations, but a revenue shortfall in the second half would accelerate balance sheet concerns.
Enphase Energy is the primary competitor and most direct peer. Enphase's microinverter system competes with SolarEdge's DC optimizer architecture in residential solar. Enphase has shown stronger margin stability during the downturn. Its higher-priced system serves premium residential customers with better retention economics. Enphase's recovery is ahead of SolarEdge, providing a benchmark for what SolarEdge's recovery could look like.
First Solar is a broader solar peer focused on large-scale utility solar panels, distinct from SolarEdge's power electronics. First Solar has benefited from IRA domestic content provisions and has shown strong U.S. revenue. As a utility-scale manufacturer, First Solar's recovery has been stronger and earlier. The comparison highlights how the residential solar correction has been more severe than utility-scale.
Array Technologies manufactures ground-mounted tracking systems for utility-scale solar installations, distinct from SolarEdge's residential focus. Array's exposure to utility markets has insulated it from the residential inventory crisis. The performance contrast illustrates how the 2024 pain was concentrated in residential and commercial rooftop solar, not utility-scale installations.
SolarEdge at 1 times revenue trades at a deep discount to Enphase at 4 to 5 times revenue, reflecting Enphase's better margin trajectory and less disrupted residential business. Bull case targets of $40 to $50 for SolarEdge imply re-rating to 2 to 2.5 times revenue as profitability returns. Bear case targets near $20 assume continued margin compression and revenue stagnation.
SolarEdge options ahead of Q1 reflected high implied volatility. The stock's extreme sensitivity to gross margin data creates wide expected move ranges. Pre-earnings positioning was cautious, with puts modestly outnumbering calls as investors hedged against another EPS disappointment. The revenue beat provided relief, but the EPS miss confirmed that margin recovery is slower than consensus had assumed.
Post-earnings options activity was defensive. The 7.5% stock decline on an EPS miss, despite a revenue beat, reflects how margin-focused the market is on SolarEdge. Near-term puts are concentrated at the $25 to $28 range, betting the stock tests recent lows. Call buyers targeted the $35 to $40 range, positioning for margin recovery confirmation in Q2.
Insider activity at SolarEdge has been limited. No significant open market insider purchases were disclosed in the last 90-day window. Management has not announced buybacks, consistent with the company's cash conservation posture during the recovery period. Insider activity is a neutral signal, no purchase conviction from executives, but also no large-scale selling that would signal deeper concern.
The combined signal is cautious. Revenue recovery is real. 46% growth confirms the trough is behind SolarEdge, but margin misses are persistent, and the market is pricing a longer recovery path than bulls had modeled. Gross margin trajectory in Q2 and Q3 is the binary signal for this stock. Investors with a 12-month horizon need margin improvement before the position pays off.
SolarEdge reported Q1 2026 revenue of $310 million, up 46%, beating estimates. EPS of negative 43 cents missed the negative 28-cent estimate. The stock fell 7.5% on wider-than-expected losses.
Bottom line, SolarEdge is recovering in revenue but not yet in margins. Bull case is gross margin recovery to 20% by year-end and profitability by 2027. Bear case is persistent margin misses delaying the turnaround. Q2 gross margin is the most important number to watch.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.